The first thing I'd say is I'd really stress the importance of a diversified portfolio. So I'm aware every strategist always would say this, so it's always true. But in such a complicated world where we're seeing the world's trading system, economic system fracturing, we think that unfortunately we're all going to have to do a little bit more work. You can't just be risk on and kind of not worry about it. We're all going to have to be much more focused on exactly what exposure we want in our portfolios. So we would be very diversified. I mentioned we're still constructive US equities, but we want to have significant global exposures to benefit from structural tailwinds around artificial intelligence, some of the geopolitical kind of rewiring that we're seeing, regions including the Middle East, including the GCC in particular, seem to be benefiting to some degree from the new ecosystem, in particular with relations with the US really deepening. I would also say we're still concerned about inflation. So inflation's still quite high in the US, and this is a problem for us when we're thinking about how we preserve our purchasing power. So we'd also in the portfolio want to have an inflation resilience, be that gold, be that other assets that can maybe give us that resilience. So I would summarize, be diversified, we have to be a little bit selective, can't just be so simplistic, and think about those different geographies which can give you the right exposures to benefit from these huge structural tailwinds which we think are going to persist.
Which geographies would that be?
So a little bit of a mixture. So I think we're going to have to pick our spots. So we look at emerging markets, so we are neutral emerging markets overall. So if I were looking to pick a couple of spots within emerging markets, on the tech side, Korea and Taiwan come to mind, and on the demographic tailwind, India still has a lot of room to grow, I think, in the years ahead.
It was quite a year for gold in 2025. Where do you see it heading in 2026?
Yeah, it's been great. So it's really played a fantastic role, I guess, as it has for much of the last 6,000 years in terms of providing inflation protection. So as I mentioned, inflation has been a bit of a problem for several years now in the US and globally. So it's no huge surprise, I suppose, to see gold playing that traditional role. I also think there are some concerns about traditional safe havens. So we can think about the US Treasury as an example. So the US already has quite a significant amount of debt, quite a huge debt by historical standards, and fiscal deficits continue to be rather large, meaning that debt should continue to grow and grow and grow. So holders of that debt, I think, are a little bit nervous about the scale of the deficits and the kind of seeming political desire from all parties to continue to want to grow the debt. Obviously, they're trying to grow growth, and hopefully that works. But if you're a holder of that debt, it's a little bit unsettling. So I think there's a determination from many global investors to diversify away from traditional safe havens into a whole range of assets. There's no easy one alternative to the US Treasury. So I think it's kind of a mixture of assets, including emerging market local currency bonds, but gold is definitely on that list.
Do you have a projection as to where you see it in 2026?
We don't have a specific price target, but I think it can play an important role. So we would think a reasonable allocation, somewhere between 2% and 5% as part of a well-diversified portfolio can make sense. Although I always want to stress it depends on exactly what your financial goals are. So there's no firm answer for that. It will differ for different people.
What about currencies? So what are your preferred currencies for 2026?
Yes, it's been a lot of conversation about the dollar, of course, over the last 6 to 12 months. For us, the US is still an exceptional place. They've got many of the good companies. The technologies of tomorrow continue to be invented largely in the US. So we think that's going to continue. And as I mentioned, we're still overweight US equities. However, we do think that there are significant opportunities all over the world. So looking forward, we're interested in Japan. We still think it's quite interesting, going through, again, a mixture of a growth boom by Japanese standards. So they're seeing huge nominal growth versus almost no growth for 20 or 30 years, and an encouraging corporate governance reform story. So Japan would be on the list of economies we think can continue to benefit. We're overweight Japanese equities. So again, we'd think global investors can look to diversify into a few economies, and Japan would be on the list.